Hi, greeting you all here. I'm Julia Wong. For this video, I'm going to explain about whether to buy call or put option in order to hedge the company position, and I hope my video can make it clearer about the concept. First, I would like to give a simple explanation about call or put option. Call option is a contract between two parties to exchange a stock at strike price by predetermined date. The buyer of call has the right but not obligation to buy the stock at the strike price by the future date, while the seller of call has the obligation to sell the stock to the buyer at the strike price if the buyer exercises the option. Next, the put option is a contract between two parties to exchange a stock at strike price by a predetermined date. The buyer of put has the right but not obligation to sell at the strike price by the future date, while the seller of put has the obligation to buy the stock from the buyer at the strike price if the buyer exercises the option. In other definition or words say that call option gives the buyer the right to purchase the underlying asset at the strike price at any time before the expiry date. So, the seller is obligated to deliver the underlying asset at the strike price once assigned. A put option gives the buyer the right to sell the underlying asset at the strike price before the expiry date. With this option, the seller is obligated to purchase the share from the holder. For example, a stock put option with a strike of $10 means the put option buyer can use the option to sell the stock at $10 before the option expired. For call option, if there is strike price of $20 means the call option buyer can use the option to buy the stock at $20 before the option expired. So if investor buy calls means that they think the share price of the underlying security will rise, and it can be exercised at any time before the option expires. On the other hand, if investors buy puts, they think that the share price of the underlying stock will fall. Moving on, I would like to share about how to hedge with options. Hedging with options involves opening a position that will offset risk to an existing trade. This could be an existing option or position, another derivative trade, or an investment. While hedging strategy can't entirely remove all the risk, as creating a complete net zero effect is nearly impossible, but they can limit the risk to a known amount. The theory of hedging is that while a position declines in value, the other position will make a profit or creating a net zero effect or even a net profit. As options are a complicated instrument, it is important to understand exactly how they work before start hedging. When hedging using options, investors need to consider how much the premium of the trade and also the option to speculate on the investment idea at very low cost by either call or put option. A company, FCUK London, received $1 million at the end of 6 months and buy an option to exchange dollar for pounds at the rate of 0.64. Spot exchange rate, which is 0.65 pound per dollar. The volatility is given by 0.1. The risk-free rate for dollar is 0.06, and for pound is 0.04. So here show my some details and formula by calculating the cost of put option. In my opinion, I would say that if FCUK London company buy today, the right to sell at given price in 6 months and receive a payment of $1 million. Here is the final answer that I calculated for put option price, which is $16,000 plus. So for me, I do recommend the company can buy put option instead of call. As when buying option, usually we choose the one that we confident and feel possible ones that may improve the chances of the profitable trade. Why I would say that way? As in real world, majority investors usually buy put since it comes with low risk but potentially high reward if the trade works out. Also, buying put can also help to hedge downside risk in a portfolio to hedge a long position. So, buying put option, the company can limit the risk of loss to the premium that it paid for the put. In addition, buying put able to give leverage as the company does not have to spend as much money as no longer they will need to sell their stock. In other words, the company able to be protected against lower prices potential to benefit prices from higher price if the market increase. The company can either accept or leave the guarantee price. If the price go higher, they can sell after buying the option. Yet, if the market goes down, the company has the price protection with the put option at a selected strike price, and also the company can decide to make an offsetting transaction if the market value increase. There are several advantages of hedging using put option for the company. First of all, it is reducing the risk of price decline. Also, it has no margin deposit required, profit leverage in obtaining credit, and established price that helps in production management decision. Moreover, the company may be more accessible and greater flexibility in cancelling commitment when needed. On the contrary, there are many disadvantages of buying call option. Although the maximum reward is limitless in call option, but there is potentially high risky trade if the premium they paid that the option never exercised. Also, the reward could be lost if the call option expires worthless. In my conclusion, anyhow there is no right or wrong. It is completely dependent on how the company is willing to tolerate the level of financial risk appetite and the faith in the direction of the price movement. For example, how much they will buy at the beginning, how much the price they want, and also consideration of the date of expiration. For both the put and call option, it only gives trader a right but not obligation. Therefore, it is important to keep in mind that general statistics to apply all options before buying and understand an option contract's value and profitability when considering a trade. Hence, before buying a call or put option, it is important to understand the basics of option as they can expose an investor to the unlimited risk. Once a basic understanding is established, investor can start to formulate strategy and discover the advantages of put and calls. Neither is particularly better than the other. It depends on the investment objective and risk tolerance for the investor. So yeah, that's all for my sharing video, and thanks for watching until the end. Thank you.